Markets fool most men because most men do not care to understand the nature of movement. They want excitement. They want to be where the action is, and so they fall into the jaws of danger without realizing they've stepped into the lion's den. The appetite for immediacy blinds them to consequence. If I have learned anything worth teaching, it is that price becomes clearer as you move farther away from it. The man who stares too hard at the ticking needle sees only the trembling hand, never the direction in which the wind blows. He becomes mesmerized by the flutter and forgets the force behind it. The higher time frames are the wind. The lower time frames are the rustle of leaves that distract you from the coming storm. I have known traders, smart men, earnest men, who sit glued to the minute chart as though God himself were whispering through each candle. They watch every tick with religious devotion, and they believe they can outthink a market where fortunes move with the force of tides. They study patterns within patterns, seeking meaning in movements that signify nothing beyond random noise. They win a few wagers, enough to taste the sweetness of belief that they possess a special gift, and then the market takes it all back, plus interest, because the truth is simple. No one owns a market they do not understand. The smaller the time frame, the greater the illusion of control. You feel powerful because you're making decisions, but decision-making without context is just gambling dressed in the clothes of strategy. There is always a price to be paid for making decisions too quickly. The short-term charts speak in riddles wrapped in confusion. Every move looks meaningful when you're close enough to count the pixels. Every retrace feels urgent, as though missing it will cost you a fortune. Every red candle stirs panic, and every green one summons greed. The emotional whipsaw becomes your master. To trade that noise is to allow the market to train you like a show animal: jump when it twitches, flinch when it snaps, perform on command. Higher time frames free you from that carnival of impulses. They show the broad river, not the tiny ripples on its surface. You want to know where the river flows, not whether a pebble fell in and splashed for a second. The destination matters far more than the disturbance. When I studied my greatest winners, the trades that defined a season or funded a year's living, I found no minute charts behind them, not once. They were built on the weekly and the daily, sometimes even the monthly. I discovered the predominant trend, I aligned myself with it, and then I kept away from the frenzy that happens inside of it. The profits came not from cleverness but from patience wedded to clarity. A speculator's first job is to determine what the trend is. His second job is to obey it. His third, which few master, is to resist the urge to tinker with what's already working. Most men fail at the second job because they insist on dancing to the market's every heartbeat. They cannot sit still when the position is right, and so they turn victory into defeat through restless meddling. Many traders believe the lower time frame gives them an edge. They say it sharpens entries, reduces risk, improves timing. And it can, but only for a man who already knows the story in full. If you're lost, zooming in doesn't help. You need to zoom out and find the landmarks first. If you read a single paragraph of a novel and try to guess the ending, you'll be wrong most of the time. But if you read the whole chapter, and then the next, you begin to see the motives, the momentum, the direction. The market writes its chapters in weekly candles, not seconds. The smaller time frames hide more than they tell. They show you the argument between two traders but conceal the verdict of the crowd. Trading on a higher time frame demands patience, and that is why most traders avoid it. Patience feels like doing nothing, and doing nothing feels like failure to a mind trained on action. They would rather trade 10 times a day and feel alive than sit quietly for 10 days waiting for the right moment. The illusion of productivity becomes a trap. But markets do not pay for excitement. They pay for correctness. They pay for sitting tight when the work is done. It is a peculiar fact that most of the money is made not by thinking fast, but by thinking clearly and acting slowly. The best trades often require you to do nothing for long stretches, and doing nothing well is among the hardest skills to master. Of course, there are times when you will doubt the wisdom of waiting. When the market chops, retraces, revisits old ground, you will feel the itch to act. The silence becomes unbearable. You will see lower time frame swings that look like opportunities to improve your position or squeeze out extra profits. This is where most men lose. The biggest mistake I see in traders is not ignorance, it is interference. They get into a fine position that aligns with the higher time frames, and then a tiny dip on the 5-minute chart shakes them out of a winning conviction. Fear whispers that the small loss could become a large one, so they abandon ship just before it reaches harbor. They exit, take a small profit or a needless loss, and watch the larger tide carry the price exactly where they first believed it would go. The market arrives at the destination without them. Experience teaches a man that staying in the trade is often harder than getting into it. Endurance, not entry, separates the winners from the wanderers. A higher time frame anchors you in purpose. It forces discipline by removing the temptation to react to every tremor. When you see that the weekly is rising, the daily is confirming, and the structure remains intact, the intraday fluctuations become harmless chatter, background noise, nothing more. You don't cut a strong position because the market coughed. You wait for a true change in direction, a structural break that invalidates the original thesis. The breakout and the breakdown are not mysteries. They telegraph themselves in the higher time frames long before the lower ones reveal them. By the time the 5-minute chart screams the news, the weekly chart whispered it days ago. Some traders ask why a higher time frame reduces risk if the stops are larger. That is the thinking of a man who measures his risk by points instead of probabilities. Size alone does not determine danger. A small stop in a chaotic environment is not safety, it is fragility. You will be stopped out many times because there is no clarity, no true support or resistance, just the random collision of buyers and sellers feeling their way through fog. A larger stop, placed where a higher time frame structure breaks, is far safer, because if that line gives way, the reason for the trade has ended. You're not hoping anymore, you're acknowledging reality. Risk should be measured not only by distance, but by meaning. When you trade on higher frames, your decisions are tied to the market's backbone, not its nerves. You're betting on the skeleton, not the skin. The market will always tempt you with the promise of quick riches. The siren song never stops. I have been seduced by that promise more times than I care to recount. The faster the chart, the louder the siren song. The illusion grows stronger as the time frame shrinks. I made some of my costliest errors when I allowed myself to believe that speed equaled sharpness, that rapid-fire decisions were the mark of a skilled trader. The market punished me each time, extracting tuition in the currency of regret. When I returned to patience and distance, the profits returned as well, not steadily, not smoothly, because speculation is never smooth, but reliably enough to remind me where discipline lives. Discipline lives in the space between impulse and action. Most young traders think they need to be active to make progress. They confuse motion with momentum. But you cannot harvest a crop by pulling on the stalk. You have to plant it in the right season, water it carefully, and leave it alone. Trust the process, not your anxiety. A trend is a season. When you enter in harmony with that season, you let time do the work. You don't dig up the seed every afternoon to see if it has sprouted. You don't second-guess the soil. You wait, because waiting is part of the work, not a break from it. A man must also learn to admit when he's wrong. Pride destroys more accounts than ignorance ever could. The higher time frame does not excuse stubbornness. It simply gives you a clearer place to admit defeat, a line in the sand that cannot be argued with. When the trend turns, it turns. You'll see it on the higher frame long before you feel it in the day-to-day noise. The change announces itself to those who know how to listen. The wise trader cuts with obedience, not argument. He doesn't negotiate with the market or beg for one more chance. That habit, above all, preserves capital. And preserved capital is the only capital that can compound into fortune. If I could hand a trader one lesson without making him bleed to learn it, I would tell him this: trade less, observe more, follow the major direction, and use the lower time frames only to execute the decisions the larger ones justify. Think of the higher time frame as the judge and the lower time frame as the clerk. The clerk carries out orders. The judge makes the rulings. The market rewards alignment. When you swim with the current, even a modest paddle takes you far. Fight the current, and even the strongest stroke exhausts you into failure. In the end, the higher time frame frees you from yourself. It quiets the impulses, starves the need for constant decision, and lets you build positions that matter. It reminds you that the market is not a slot machine, but a living thing moved by human nature. And human nature unfolds slowly. No crowd changes its mind in an instant. Fear rises like a morning tide, gradual and inevitable. Confidence fades like evening light, dim by degrees. Those movements are captured best in the weekly strokes of a chart, where the broad brushstrokes of sentiment become visible. Daily charts show you the mood. Weekly charts show you the character. There will always be men who ignore these truths. They will come and go, flashing bright and burning out, shouting their wins and hiding their losses, always hoping for that one day that changes everything. The gambler's dream never dies. The trader who aligns with the higher time frame does not need that day. He doesn't chase the lottery. He takes what the market offers again and again by being in the right place at the right time, doing nothing foolish in between. Consistency built on sound principle beats brilliance built on luck every single time. The market will continue long after every one of us is gone. It has survived wars, depressions, manias, and collapses. It rewards discipline and punishes noise. When you learn to see it from above, the chaos below becomes merely motion without message. The frantic movements lose their power to command your attention, and when you see clearly, you act wisely. And that, more than any clever trick or secret method, is what keeps a trader solvent, confident, and alive in the game long enough to reap its fullest rewards. Survival first, profit second, and glory never. That is the order of importance for anyone who means to last.